Hey everybody, I'm Marcus. Thank you for coming to this event. I am here to talk about a study that was recently concluded by the Wharton School of Economics to assess the average market participant's willingness to tolerate abuse. The study was conducted over a 5-year period. It was called DeFi. So what they did for this study was they created this open marketplace for crypto assets and try to make the execution as bad as possible, right? So the environment had the following factors. They made sure that there was massively fragmented liquidity. Cryptocurrency as an asset class is permissionless. Anyone can set up an exchange for it, whether it's a centralized exchange or a decentralized exchange. So everybody built exchanges because exchanges are a very profitable business. So that led to a lot of pricing variance just in the marketplace overall. They also enforced a huge amount of variance in trade finality time. So a exchange is continuous, like a centralized exchange, it's a continuous marketplace. You're getting instant execution, but they also had decentralized exchanges that ran on a variety of different blockchains and execution environments with discrete finality. So all of a sudden you have this trading environment, and some trades are settling instantly, some are settling in 12 seconds, some are settling in 5 seconds, and then on top of that you introduce leader rotation, so now your jitters all over the place. Some trades are hitting the exchange in 10 milliseconds, some are taking 100 milliseconds because now the validator is in Russia and it used to be in Tokyo and your box is on the wrong side of the world. So yeah, that wasn't great. And then they made sure that all the infrastructure was built by poorly funded companies that didn't actually have a very professional DevOps setup. So your RPC is lagging, your API layer just doesn't work, you can't get a trade in, you're getting rate limited all the time. Yeah, not great. And then next, they varied the custodian risk a lot. Some of these custodians were smart contracts that could have bugs in it. Some of them were sketchy centralized exchanges ran out of like Russia or Asia that might just disappear with your money. And it's a massive risk to have funds there. So not everybody's willing to trade on every exchange. And then finally, they made a lot of the venues actually inaccessible, whether that was due to complexity or whether that was due to actual jurisdictional restrictions. So you might have Upbit, which has a lot of Korean retail flow and has very disparate pricing, but you're not actually allowed to trade on Upbit unless you are a Korean individual. Not a Korean market maker, not a Korean desk. You just can't get access to their prices, so there's a massive arbitrage like almost all the time between Upbit and the rest of the world, right? And then you also just have the complexity issue. Like, my grandma knows how to trade on Coinbase, my grandma doesn't know how to trade on Hyperliquid. There's going to be a spread between those two venues because the flow can't actually distribute. So yeah, all of these factors combined led to just a huge pricing variation across venues. And then on top of that, you add a huge amount of volatility to the asset class. All of a sudden, the spreads are massive. Most of your volume is arbitrage. Not a great place to actually try to execute a trade in. So yeah, it turns out at the conclusion of the study, they found out that it turns out market participants don't really care about how much they're getting ripped off in the execution environment. They'll throw off their trade and then they don't really think about it afterwards. So you're seeing statistics like the majority of trading volume on exchanges actually being arbitrage related. I'd say 90%, 95% of trades are related to some kind of arbitrage. The majority of public trades, so trades that are put through a public menu, are either front ran or back ran. So you're getting abused actually in the order flow execution pipeline. And then, yeah, markouts are bad across the board. Your execution quality is never really good. And they're also very highly variable. Some asset classes have fairly good execution on some venues and bad execution elsewhere. Some asset classes have bad execution everywhere. But bottom line is there's a huge amount of variance, and the variance is inconsistent. So unless you were highly sophisticated, it became almost impossible for you to reasonably perform trading activity in this environment. So we can take a specific example that I like from one specific trade that happened a couple months ago. We're going to call the trader Timmy. Timmy wanted to buy Jito. He had just seen a big Jito announcement. He wanted to put $1 million into Jito. Unfortunately for him, all of his money was in wrapped stake ETH on Ethereum, right? So he knew that all the Jito liquidity was on Solana and USD Jito, right? So he first had to sell his wrapped stake ETH. Unfortunately for him, he didn't go to a solver network. He just went to a router and he sold $1 million of wrapped stake ETH into liquidity pools and realized around 2.5% slippage. So his cost is already at 2.5%, right? Now he goes to bridge his USDC. That takes around 15 minutes. So by the time his money lands on Solana, the price of Jito is already up 10%, right? He already lost 10% on the trade. He hasn't actually done the trade yet. So at that point, he still decides to buy, of course, right? Because he has FOMO, the price is moving up. He wants to get positioned. So he shoves $1 million into a Solana router, gets sandwiched for around 5% because his slippage limit was configured poorly. And then also, the majority of the Jito liquidity was actually on Binance. So he should have executed on Binance. Maybe he couldn't for some reason. And the price moved back down to like 1% above the quote that he originally got after being sandwiched for 5%. So he lost around 2.5% on the sandwich, and then let's say another 2.5% on just like bad execution. So in total, he lost around 17.5% on that one trade immediately, as soon as that trade was finalized. And that was just due to slow execution. Took around 20 minutes for him to actually get the trade through. Fragmented liquidity. He should have been hitting multiple liquidity sources for wrap stake ETH. He should have been hitting multiple liquidity sources for the Jito trade. It was because his trade was actually public. And then it was because of exclusive venues. He didn't have Binance access. Even if he did have Binance access, he definitely wasn't a high fee tier on Binance, so he's still getting a high fee on his actual trade. So who am I and why am I talking about this? My name's Markus. I've been in the DeFi and MEV space for quite a long time, and like many others in the space, I've seen this is a massive problem. Our trade execution is really bad across the board, and I care a lot about DeFi. I think permissionless financial innovation is good, and I think for it to succeed, we need better execution rails than traditional finance has. So I started working on this thing called Tplus around 3 years ago. Most of the work was research because it was kind of a hard problem to solve in the way that I wanted to solve it. And then we started actually building it around a year ago. But when I was coming to ideating Tplus and like thinking about what I wanted to build here, I approached the order flow execution problem from first principles. There were a lot of small problems that were apparent throughout the stack that you could approach individually, but I didn't think that was a good approach in this instance. So I went about it from first principles and decided that what we needed was a fast, consistent trading environment. We needed the trades to all be private. We needed the venue to be trustless and permissionless. And then we also needed it to be fully composable with every chain, not some chains. It needs to be fully composable with as many liquidity sources as possible. And then we also need a lot of margin. And the hard part about doing all of those things at once is I didn't want to make a single trade-off on any of those components, right? It would have been a lot easier to make it just composable with ETH mainnet, right? But then you're like solving a tenth of the problem, and you're probably not anywhere closer to solving the rest of it, right? So we try to do everything at once. And I'm going to talk a little bit about how we're actually approaching that. So just going down them into why we need them and how we're doing them. On the speed part, the general rule is, at least my opinion in crypto, is that we're never going to get to a place where most of the trading is happening with the same like finality time. You're going to have discrete execution environments. You're going to have continuous execution environments. They're going to be globally dispersed. In a marketplace like that, the fastest party is going to get the best price. You want to be as fast as possible. So in order to accomplish that, what we decided that we needed was just one continuous, fast central limit order book running inside a trusted execution environment, so you didn't have to trust the operator, right? The trusted execution environments are very good at giving you integrity guaranteed and private code execution in an off-chain environment, so you can have a really fast Rust matching engine running in one box in Tokyo that never rotates unless you need to rotate it because the operator is doing something bad, right? Then on the privacy part, privacy is important. All of your trade data is very valuable and you shouldn't be giving it away for free. So trusted execution environments solve that for us. You encrypt your packet at the client level, send it to the trusted execution environment. It gets decrypted within the trusted execution environment. No one sees it, not even the operator. Then we need it to be trustless. So there can't be any custody risk. If there's custody risk, not everybody will use it. And also you now are, if you're a custodian, there's a whole bunch of regulations you need to follow. You're not allowed in every jurisdiction. It becomes very expensive to be a custodian. So we did a TEE plus MPC setup for that. No single party, not even a trusted execution environment host who's malicious, can ever access funds. And then it needs to be permissionless. And the permissionlessness isn't actually for ideological reasons. I believe in permissionlessness, but just for a market to be efficient, you want to have every single participant in that wider market able to access it. So if someone can't access it because A, it's too complex, or B, like they just don't have the jurisdictional access, that's bad. You're going to be less liquid than a permissionless venue. So yeah, we're decentralized. Anyone can run an order book if they want to. Anyone can replicate an order book. Anyone can send a trade. That is just one of the components of the system. And then next, composability. Composability, like I talked about earlier, is very important. You don't want to ever have a capital cost to access external liquidity. Every venue is technically composable because you can sell in one venue, buy in another venue. That requires you to have capital in both venues. That's an inefficiency. There's more, because of that additional capital cost, there's now more non-execution risk. So we wanted people to be able to access external liquidity venues with no additional cost. So what we did was we put all these deposit vaults for user deposits on all these different chains. And if someone wants to execute against an external liquidity source, they just ping us for an approval. We check that it's safe. And then we basically allow them to flash loan from our deposit vault, take user funds out of it, execute arbitrary call data against anything in that state machine, and then return the proceeds. And it either all executes or it all doesn't execute. Means that they don't have to have any capital on that chain whatsoever. They're using our user deposits. For centralized exchanges, we allow cross-margining. So you can run your strategy on Binance, post that as collateral to Tplus. When you get hit in the Tplus book, you sell on Binance. You're now flat in the eyes of our margin engine. No additional cost for you. And then finally, the margin's very important. Crypto is still a relatively capital-constrained ecosystem. We have a lot of capital, but we have nowhere near the depth of liquidity that traditional markets do. The way that you solve lack of liquidity is with more margin. So we offer a lot of leverage. We have a pretty robust risk engine managing that leverage. We do stuff like give delay margin checks for solvers that are directly hitting on-chain liquidity. We do stuff like allow market makers that are partner market makers to post quotes without any associated margin. And then if the margin check on the match fails, we just revert the trade. And we can do that very, very fast because we're running in an off-chain non-compute constrained system, right? So to get back to our original example with Timmy, I think it's useful to outline how Timmy's experience would have been different if they went to execute that trade on Tplus versus what they did with all the different bridging and chains. All he would have had to do is deposit his wrapped stake ETH as collateral into Tplus. Then it's just an ETH mainnet transaction, would have taken him 12 seconds minus like whatever time it took him to figure out how his wallets worked. And then he either sells it or just posts it as collateral and buys $1 million of JITO on margin. He's done. He's done with the whole process in probably under a minute, realistically. And on the other end of his trade, once he sends that like large JITO buy into the book, there's a bunch of different market makers running different hedging strategies. So we have market makers that are quoting against Binance liquidity, and he's going to hit their quotes, and they're going to go immediately buy JITO on Binance to hedge their exposure. They're all on margin. They might have all their capital on Binance to run that execution strategy. He's going to hit some solver quotes. The solvers are going to go and take on-chain liquidity. So he is by proxy of these specialized, sophisticated individuals getting access to all these different liquidity sources without this additional cascading costs that all this these fragmented venues cause. So he just gets much better execution on the end of the day. Also, with both of those environments, getting inclusion fast on Solana is very difficult. You have to have a lot of stake weight or access to a lot of stake weight. You have to have a very good infrastructure set up. Most people don't have that. A couple people do have that. So if you can trade directly with those people in a permissionless book, that's great. Not everybody's VIP9 on Binance. Not everybody's a dedicated market maker on Bybit. Very few people are. You don't want to pay the base fee tier. You want them to buy for you. They pay their fee tier, and you pay them a spread, which is probably a lot less than the base fee. So yeah, at the end of the day, Timmy was treated as a sophisticated market participant instead of an average market participant by trading on Tplus. That's the entire goal. That's what we're trying to do. We're trying to allow people to get edge just by depositing in Tplus and having access to all the liquidity layer that we're providing for them and all their sophisticated counterparties. So that was kind of a lot, but at some point I needed to talk about why I'm here, what I'm doing, instead of just posting Klob and a T on Twitter. But yeah, we just released our, it's kind of like a demo. We have an internal production version of Tplus running right now. It's running on the screen downstairs. You guys might have seen it. The link will be posted very soon, so everybody will be seeing it. But that's just Charco and LA trading against each other on Tplus. Yeah, and we're also hiring. If anybody is interested in optimal order flow execution, we're hiring for both front end and back end roles. It's a great team. We're fun. Come work with us. And then most importantly, we're planning to be live in Q2. Come trade with us. Come market make for us. Come send us your flow. We are happy to walk you through every feature and get you integrated in exactly the way that you want to be. But most importantly, thank you guys for being here. Enjoy the event. We're going to have some very interesting panels, debates, and then you can go gamble money on guinea pigs.